Alrighty, you guys, welcome back to the channel. Welcome back to another episode of Portfolio Reviews. This is episode number 2. In this episode, I'm going to get a little more nitpicky. We're going to be reviewing 4 portfolios. A couple great examples, a couple that I think need work. In the first episode I kicked this off, we looked at a couple great examples. And I thought, you know what? You guys actually may get more value if I do look at them with a little more scrutiny. The concept for this series, FYI, is this is obviously not direct investment advice, personalized advice to any of these people who submitted their portfolios. The concept more so is for me to just take my second set of eyes, from my experience in the market, working professionally with my father for 4 years, where we literally manage portfolios on a day-to-day basis. What are some of the glaring things that are jumping out to me, and maybe point some directions that these particular investors may benefit from, and for those that are building portfolios, take bits and snippets of this and see, maybe that I can apply this or not. And for context, I actually requested a little additional details. So we had all of these various users submitting, their age, what they're investing for, and we will review this as we go through because this is context that is super, super valuable. But I want to start off with this gentleman right here, Anthony J.R. Leones. Thank you for submitting your portfolio, your first victim. He says, my wife and I are 25 years old. We just had our first baby girl. Congratulations on that. We're planning on making our portfolio another source of income for retirement/early retirement. First, dividends and reinvesting those dividends. I said willing to take on a decent amount of risk as I'm young, or as I actively manage my account. I'd love to hear your thoughts. Well, here's Anthony's portfolio. He's based in Toronto. He says he's a Canadian investor, and he mentioned there dividends is a big focus. If we take a look at the breakdown, it looks like an entire portfolio of individual stocks. So this investor has selected to not go the route of a broad-based ETF, instead craft his own portfolio of 15 different holdings. As we see here, companies like TD Bank come in at the largest. Lyft, I'm actually not familiar with this one, but I assume it's some sort of income-related holding. We have a REIT, so there you go. You got a broad, diversified real estate product in Smart Centers. Enbridge, Timber Creek, Bell Canada, CNQ, Algonquin. You guys can pause the screen if you care. But a big list of dividend-paying companies. And in fact, if we scroll down over here, he says his current yield on cost is 8.4%. So obviously this portfolio is doing a great job of what it is after in terms of spinning off income. I have no issue with the holdings. I take a look at these, and these are obviously our big blue chip, Canadian companies, very high quality REITs. Obviously, some of these companies have been struggling a little bit. Something weird's happening above me. But what is glaring to me, what is glaringly, I don't want to say wrong, Anthony, because again, to each their own, but the decision to only invest a strictly Canadian company portfolio, to me, right off the bat, that is, I'm unsure why an investor would do that. Now, I get it. It's very popular. There's a term known, that Canadians struggle with all the time. There's a term investing known as home bias. We've talked about it on the channel a lot. Home bias is a tendency. It's a flaw, I would argue, where investors over allocate, they overexpose themselves to their home market. And that's very logical, right? Because growing up in Canada, you think about where we go to do our banking, what phone providers we use, what businesses we're surrounded with. All we see is Canadian products. So very logically, we think, well, I should be investing in these Canadian companies. But the last I checked, I think the Canadian economy represents 2, maybe 3% of the global world of investments economies out there, right? It's relatively small in the big scheme of things. And again, it's what we're exposed to. But my approach as an investor is, we sit here and we want to allocate our money to the best possible options and investments available to us. And that oftentimes does expand beyond our native market. Now, nothing, again, wrong with owning Canadian exposure, and there are certain advantages when you get to bigger dollar amounts, but for someone who's 25, I'm going to assume you're investing in maybe a TFSA, Anthony, which is tax sheltered anyways. You're not necessarily benefiting from, for instance, the dividend, like eligible Canadian dividend stocks. Again, I could be wrong there, but my glaring point to this portfolio is, man, I think it should have some US exposure. I think a portfolio should actually be predominantly focused on US investments, being that that's the largest market in the world. There's the largest companies in the world. I will, to counter that, Canada is known for their dividend stocks. As we can see here, these are all tremendous dividend payers like TD, Enbridge, Bell Canada. In my honest opinion, there could be some benefit to expanding this. And a very easy solution, just to give some ideas out there, is doesn't have to be individual stocks. You could buy a fund like SCHD. SCHD is a Schwab dividend fund. Now, this is an American fund, so there is a currency play, factors at play here. However, this is giving you exposure to the top U.S. dividend stocks out there. If you break it down, you're going to see a ton of amazing U.S. companies. One fund solution could help balance out that portfolio while still catering to the desire of building a dividend portfolio. Again, maybe one other argument to be made is if you're 25 years old, Anthony, and you want another source of income for retirement, you're probably not tapping into this money today, right? You're not pulling out the income today. Like you said, you're reinvesting them. So again, I don't see anything wrong with getting that snowball going, but there could be an argument to be made. Well, when you're 25 is have the portfolio more structured for growth, a hybrid, you got some growth investments, i.e. tech, right? Like, for instance, there's no tech in this portfolio. You could easily have some tech holdings, which are, performing well, and the overall value of the portfolio is growing and growing and growing. And then in due time, when it comes time to early retirement, you can start maybe skewing these. Again, I totally understand, and he did emphasize his priorities dividends, so I'm not going to argue with that. But those would be a couple of my thoughts. I definitely think there could be some U.S. exposure in this account. Let me know what you guys think down below. And thank you, Anthony, for being our first submission. Let's move on to Danielle. Danielle is from Quebec, 52-year-old newbie trying to learn the most at this big investment world. Hey, very exciting, Danielle. And this is another one where I would say I kind of like what you got going on here. I think it's great. I don't see anything overly wrong with the holdings. In fact, after reviewing the holdings, I'm a big fan of the individual stocks. McKesson, this is kind of a slept-on company, but I love it, and she's clearly done very well in that 170%. I love the railways. Sorry, I think I'm getting summoned downstairs. I love the railways, the big banks, Couche-Tard. These are some of my favorite holdings here in the Canadian market. Again, we notice majority of the individual holdings are Canadian holdings. Again, that's fine. But the biggest thing that jumps out to me here with this portfolio is for a beginner, like you consider yourself a newbie, and I love the fact that you're upfront and honest about that, Danielle. I think that this index fund right here, the S&P 500 fund, should come in representing closer to 50, 60, 70% of the portfolio. So when I view this pie chart, in my opinion, there's a strategy known as the core. I've always called it the core satellite strategy. Now, there's also another term for it known as the core and explore strategy. It doesn't really matter. Basically saying the core or the foundation of your portfolio is in, let's call it a broad-based, I don't want to use the word safe because investments are volatile, but a diverse basket of stocks, which you're absolutely achieving here with VOO. And then you absolutely can play with your individual stocks. And again, however she's selecting these, I think they're awesome. I think especially for a 52-year-old investor, she's selected, not overly aggressive companies like the Fortises of the world, the Power Corps. Again, maybe she could incorporate some US ones like the Walmarts and whatnot out there. And in fact, on that vein, not that she doesn't have exposure to this too, but she does have some tech exposure via VOO. Even though you're a 52-year-old investor, I don't think people in their midlife, like mid or later life, should be neglecting tech. And again, understanding the VO, what VOO owns, you're getting a good exposure to the Meg 7, don't get me wrong. But I do see a world where even the more conservative investor, not overly conservative, but let's say someone in their 40s, 50s, companies like Microsoft might be a good one to look into. These companies are just killers. And I notice, like, again, a lot more of the conservative, medium risk funds, great. I do see a world where probably wouldn't hurt to have a little bit of that in there. But my biggest take on this portfolio is I love the VOO holding or the S&P 500 holding. I would feel a lot more comfortable as a newbie inching that up to 50, 60, 70% of the portfolio. That's your core. Then have your fun with your individual stocks. And when you do have a play like McKesson that does super well, or here, National Bank, she's done well on, maybe she's held that for quite some time, you still have the opportunity for those stocks to outperform, but you're not banking on 75% of your portfolio on individual stock picks where you have the onus of essentially timing. When is a good time to buy? When is the entry point? Again, if she's willing to hold these stocks for the next 20 years, she's probably going to partake in the growth. Don't get me wrong, but that would be my main piece that jumps out to me on this portfolio is bring that up. I also see the XEQT holding here at 5%. Again, these two are these two can act as the core, right? These two holdings right here can be that 70% of the portfolio. You could even look if you are interested in, I see the low the low volatility holding here, nice. If she is getting a little more, if she does deem she's a little more conservative, you could even look to something like X Grow, which has a 20% incorporation of bonds, fixed income, possibly even more. But overall, again, I like what she's doing. She's done well, right? It's tough to say how long she's been investing. In fact, I should probably see it here if I dig deeper. But yeah, she's got a nice, decent return on her portfolio. So keep up the good picks. I like the quality of companies you're picking. I would just say don't exclude the U.S. market because there's a ton of great companies that I think would suit this style. Companies that come to mind is Unilever, maybe a Procter & Gamble. Like these are right in the same vein as the Fortises of the world and our consumer staples, a Walmart. Those are companies that are just as reliable as these. They're just getting exposure to the other market. Just something to consider. Now, I will finish off here with a couple good examples, and I'm not going to comment on the profile picture selection here from Jordan, but Jordan, in my opinion, you know what? And I missed the last, who was the last one we were checking? We were just checking Danielle. Let's see if we have any additional insights here from Danielle. There's Jordan, who we're covering now. So he's a 34-year-old long-term investor, DCAing 1 per week. We'll jump back to that. I don't want to make sure I missed this from you, Danielle. There she is. Sold my house 10 years ago. First time I heard about these, got some great tips. Advice. Look at my investment more seriously. I also have an active RSP 52. Love to return. Not hitting dividends, but I know I need to grow more. Would love to clean it up a bit. Hey, I like that, Danielle. And if you are looking to clean it up a bit, again, you do have a lot of individual holdings, and it's not the end of the world. It's just I personally like them. I like the holdings. They're just all Canadian. This portfolio with Jordan, I'm assuming that's not Jordan in the photo, but this is an example of what I believe is a stellar breakdown. I think there's not much to say. I think if you're looking to build an ETF portfolio, probably an awesome example to look to. We see VFV coming in at half the account, which is the S&P 500. We see the NASDAQ coming in at 25%, and another quarter allocated to SCHD, which is the one we actually just covered, which is more of a skew on dividends. So one thing to note is here, he's entirely focused on the US. I don't see anything overly wrong with that. You'll hear arguments for people that say, I only want to invest in the US. Then you say people want to invest abroad. I give this portfolio a big 2 thumbs up. And then actually just looking at his little submission here, he says he's investing for the long term. He's DCAing 1K per week, which is incredible. And look at that. So he even got the account selection, the currency selection right. So 100% of his TFSA is in VFV, which is the Canadian listed product. We've talked about that a bunch. Interestingly, we just covered VOO, which is the American listed product for Danielle. So this investor, Jordan, has consciously put the VFV holding in his TFSA. And then in his RRSP, he selected the US listed products, right? So SCHD, as I touched on, it trades on the New York Stock Exchange. It doesn't trade on the TSX. So this product is traded in US dollars. And a benefit to doing that is in the RRSP, the dividend income that he earns from an account from a product like this, which is especially notable on a US dividend fund, it is exempt from the withholding tax if he were to have been holding this in his TFSA. So 15% withholding tax exempt. He's located his assets, in my opinion, very well. And I got nothing but good to say about this portfolio. The last one I want to finish off with you guys is one Solo Faya. This is an incredible user on the Blossom platform, and shout out to you for she's been a shareholder too. So let's go, even double benefit, double bang. 700K portfolio on Blossom. This is an individual stock portfolio that I just thought was incredibly crafted. And it's funny, I went from a portfolio of individual stocks to obviously ETFs, as you guys know. You guys haven't seen my portfolio, but had I stuck to individual stocks, this is the kind of portfolio that I would have aimed for. And in fact, I think my portfolio somewhat resembled this. Meta was one of my larger positions. I own Brookfield, I own Google, I owned and sold EQ Bank, Amazon, Berkshire. This is an incredible mix of both geographies. Notice here, top heavy, you have like a healthy dose of both American and Canadian. Like, in my opinion, the stellar Canadian choices. These two Canadian choices are awesome. You got a mix of technology. You got a mix of the classics, the Berkshire Hathaways, your industrials, very evenly balanced. As I mentioned on the last video, the Blossom desktop beta is still very much that, a beta. So we don't have the sector breakdowns and more of the deeper portfolio insights. But just taking a scan of this, it looks to be well diversed into appropriate areas for a long-term investor, right? This guy says he's 29 years old. I love that his top heavy exposure is to more of the growth focused areas, whether that be tech, whether that be industrials. He's not sitting high in, the Fortises of the world, and the Great West life insurance companies, which again, for this investor, newbie, may be more suitable. She's 52. Well, for this investor, he clearly has, in my opinion, knows what he's doing. He's got a clear target of a portfolio goal. The objective is to grow. And I would just say in general, man, not much to add other than keep doing what you're doing. So 2 cool examples of what I believe are an awesome ETF portfolio, an awesome individual stock portfolio, and then 2 that, again, you guys are doing awesome and I love it, but just a couple thoughts in terms of maybe ways I would personally go about doing that. Again, as always, you guys do your own research, do your own due diligence. I appreciate everyone that submitted their portfolios for reviews. You guys mentioned in the comment you like this series. You said you like this series because it kind of gives like insight onto, for those building their portfolios or have a portfolio and don't know if they're doing it right. It's like, you can kind of take bits and pieces. So that's what I'm hoping to I hope you guys get out of this, and you let me know if you find this valuable, because actually I head off to Taiwan in a couple days, celebrate Chinese New Year over there. And obviously filming does get a little more challenging, but this is a very easy series for me to do, just virtually here. So I could do that and focus in on more. If there's any specific types of portfolios you want reviewed, maybe high income or REIT focused, you guys let me know. But let me know down in the comments if you like it. If you enjoyed, give it a thumbs up. Hey, wishing everybody the best, and I thank you for watching, and I'll see you in the next video.